If you want to invest long term and not get crushed by bad assumptions, then this video may save you a lot of money. Hi, I'm Lance Hulsey, a California real estate broker, and today I want to help you understand the 1% rule and when not to use it. I want to go over why it exists, what it is, and when it actually works. So let's get into this. If you're new to real estate investing, one of the first questions you probably are asking is, how do I know if a rental property is a good deal? And that's a totally legitimate question. I get that question a lot. There's a lot of different answers to that question, but today we're going to focus on one answer that I think is really good for some initial screening. There's a lot of different ways to figure out if a real estate deal is a good deal, and it really comes down to the numbers. Um, but you don't want to waste your time analyzing deals that don't even meet like some basic criteria to help you um, kind of weed out the bad from the good. What I like about the 1% rule is that it's kind of the first pass, so to speak. It'll help you kind of just, if you had 10 properties and you use this rule, you might find that 8 of the 10 just don't even come close to meeting this basic criteria, so you can move on. Using this rule will help you narrow down the things that you need to dive deeper into, basically. So before spreadsheets, before cap rates, before complex underwriting models, investors need a simple filter to avoid bad deals. And this is where the 1% rule comes in. It's a very conservative principle that you can employ. It should not be a shortcut to any of your due diligence. So keep that in mind. You still need to do the due diligence. You still need to do the deep dive. But this is a good starting point. It's not magic. It's not a guarantee. It's just a rule of thumb. And like all rules of thumb, it works when you understand its purpose. So let's get into it. What is the 1% rule? The 1% rule simply states that a rental property should generate monthly rent equal to roughly 1% of your total purchase price. So that means, for instance, a $200,000 purchase should rent for $2,000 a month. A $350,000 purchase should rent for $350,000 a month. And when I say purchase price, I mean the all-in cost. So that's the purchase price, that's the closing costs, the initial repairs and renovations, not just the sticker price. So don't just go to Zillow, look for a property for sale for $300,000 that you find rents for $3,000. That's not going to get you where you need to be in your screening process. So here's why the 1% rule exists. It's to quickly identify whether a property might cash flow, and might is the key word there. So again, this is just a screening process. This is not your final due diligence on any kind of investment property. So keep that in mind. So it was created in an era when investors were looking to buy with leverage. The cash flow mattered. Appreciation was treated as if it was a bonus, not part of the plan. The rule is intentionally conservative because real estate has hidden costs that new investors constantly underestimate. So if you're a new investor, just remember, this is just a screening tool. This is not your final due diligence. I can't state that hard enough. So the expenses of the 1% rule that you're trying to protect you from: rent is not profit. So remember that rent is not profit ever. Rent is income, and it's gross income. So the 1% rule implicitly accounts for property taxes, insurance, maintenance and capital expenditures, vacancy, Property management costs, if you are hiring a property manager, most of them charge between 8 and 10%, just so you know. Utilities and admin costs and debt service. So if a property rents well below 1%, and those expenses tend to eat into your rent check, especially with the high interest rates we have today. So keep in mind that you got to account for these costs when you're doing the analysis. And I have a spreadsheet that I created for everybody that I'll drop in the link below when I post this video, and you can download that spreadsheet. You can also go to my website, wealthbuildingbroker.com, and I think that spreadsheet's already up there. It's called the 1% rule spreadsheet, I think, or something to that effect. Anyway, so how investors are using the 1% rule, here's the correct way to use it. Don't, like I said, don't just go to Zillow, find a $300,000 property with a $3,000 potential rent and call that a day. That's not what you want to do. So first, you got to screen the deal. If it doesn't come close to the 1%, you got to move on. One of the biggest mistakes that I know investors that are new make is that they don't do their due diligence and they don't account for all of the costs associated with owning the property. So make sure that you use this tool correctly. Step two is to use your underwriting criteria properly. Again, investors have a set criteria and they don't waver from that one bit. So, for instance, if you're flipping a house and you have an after repair value that you want to create of 70%, um, and it comes in at 71% when they run the numbers, they move on. They don't buy the property. Um, so after repair value is something that we'll get into later. If you want more on that right now, you can look it up, or ARV. But anyway, when we get back to this, the step two, the underwriting criteria. So if it doesn't meet or approach the 1% rule, then you can run a cash on cash return analysis, or a cap rate analysis, or a debt service coverage analysis, or visit your exit scenarios and whether it meets appreciation requirements or depreciation requirements. Um, the idea of the 1% rule is it saves you time before you get to uh, those analysis. Uh, why it's harder today to use the 1% rule than it's been in the past? Well, let's be honest, in many markets, especially in coastal and high cost markets like here in California, the 1% rule is rare or non existent. I'm in Santa Cruz, California. I service Northern California, and it's unless you get into some of the backwater areas of way Northern California, it's really hard to find anything that's going to get covered by the 1% rule. $1 million house can rent for $5,000. Well, that's about half of 1%. So that's not going to come anywhere close to meeting that criteria. But if you go to places like Alabama and Tennessee, Ohio, Michigan, Iowa, you can get closer and sometimes exceed the 1% rule. So price rose faster than rents is the number one killer of the 1% rule. Interest rates increase your debt costs. We're at 6% interest right now, roughly. If you're investing, you might be paying as high as 7 or 8% interest. So you got to take that into account. Insurance and taxes have gotten more expensive. Again, here in California, it's really very few companies are writing homeowners insurance policies, so you have to go to the California Fair Plan, which is very expensive. So check your states, make sure that you can get insurance in those states. Homeowners insurance, flood insurance if you need it, fire insurance, all the different types of insurance that you can think of. Big one here, regulations. Um, I would highly suggest that you do a ChatGPT search or a Google search on landlord-friendly states. Um, I can name a couple: Ohio, Iowa, Texas. Those are some landlord-friendly states. They're also, in the case of Texas, Texas doesn't have state income tax. It's something to be thinking about. That could save you a lot of money. But anyway, regulations increase operating expenses. So find the landlord friendly states. That doesn't mean that you can not invest in other states, but just, create a chart, do your due diligence. Find the states that are no state income tax, landlord friendly, and has low regulations. I mean, that right there will get you uh, way ahead of the curve, and then you can worry about price to rent, interest rates, and insurance. Um, so you have to adjust your strategy basically. Landlord friendly states again are Ohio, Iowa, Texas, Alabama. Those are some really good states to invest in. I think I read somewhere that uh, Alabama or maybe it's West Tennessee has a big Amazon facility or a FedEx facility. Well, that means jobs when they're doing a big um, distribution center. So, search the news and see if you can find, what's going on in these states by way of employment, because that means people probably need to rent and people might be migrating to those states. Another good thing to do is go and look where people are migrating to. Where are they moving out of? Where are they moving into? So I know a lot of people have been moving out of California and moving towards Texas. So maybe there are geographic areas in Texas that are good that could meet the 1% rule. So when does the 1% rule still work well? It works well in a cash flow focused market. It works well in the Midwest and Southeast cities. It works great for small multifamily properties like 2 to 4 units, single family homes sometimes. Um, it works well on value add or distressed properties. So properties that you can put a little bit of money in and get a lot of value back out of. It works well in investor friendly landlord states. I think I mentioned those already 2 or 3 times. It also works better when you're trying to buy below market. So if there's not a lot of competition and it's a buyer's market. Buyer's markets are usually when markets have 6+ months worth of inventory. So you might want to learn how to calculate the inventory. The best way to do that is just look at what's selling versus what's being listed and do an analysis and see if things are churning every 6 months. Well, if that's the case, then that's a buyer's market. If it's churning every 2 to 3 months, that's a seller's market. Um, so you want to buy where you can improve rents through negotiations or renovations. So maybe the rents have been below market and you can raise the rents. Be careful, check local regulations for that. There are rules like here in California that you can't raise rents more than a certain percentage over a year or two. It also helps if you're self managing, you can save that 8 to 10% property management fee. So, when the 1% rule breaks down, when it's not going to work, number one, if appreciation is your primary goal, that means you're just trying to grow equity. If you're investing for tax strategy alone, 1031s is a good example, or just for depreciation. Remember, depreciation on single family homes is 27 and a half years. So, you can talk to your tax guy about depreciation if you don't understand depreciation. We might do a class on that later on in this series. Um, it's not going to work if you're in a premium urban market like here in Silicon Valley, Monterey Bay Area that I'm in. That's a premium market. I'm never going to find a 1% deal around here, most likely. If I do, I'm probably going to be competing with 50 other guys on it. So and if you're putting down large amounts of cash, you know, I don't know why you'd want to worry about the 1% rule. It really doesn't work if you're going to be putting down more than the minimum amount that a lender might require for you to get into a property. Uh, So in those cases, investors might fudge their 1% to zero point 0.6 or 0.8% deals. I personally would never do that. I stick to the rules. Like I said before, investors that are successful, um, they don't want to budge off of their criteria. So they don't usually flex that way. Um, you may be if you can't get the 1%, you may be looking at lower or break even cash flow. I don't know why you'd want break even cash flow personally, but maybe you're looking for the depreciation or some sort of a tax write off scheme. Again, I'm not a tax expert. Talk to your CPA or your tax attorney about those deals. Um, and then the other thing is if you're looking just for higher or long-term growth through equity, then the 1% rule probably doesn't matter. I mean, if you're going to buy and hold for 20 years, I wouldn't be too worried about the 1% rule. So know exactly what you're giving up and why when you do these kind of things. If you're going to set the 1% rule aside and go with another criteria, just make sure you understand why you're setting aside one set of criteria for another. Like I said, savvy investors have several ways that they value a property for their investment. They don't just stick with one rule. So here's the biggest mistakes that I see new investors make. First of all, they use the 1% rule to justify a bad deal or instead of just eliminating one. So, the rule doesn't say that this is a good investment. So again, let me repeat that. The 1% rule never says this is a good investment. It's merely a screening tool to dig deeper into your other criteria. What it does say is this investment or this property might be worth a closer look. So if a deal fails the rule, you need to have a very clear reason why you're going to move forward with it if it's failed. The market always goes up is not one of them. Again, get that out of your head. The market always goes up. I might remind you, if you're old enough to remember 2007, 8, 9, 10, market does not always go up. So the people that survived that market during the financial crisis were those that weren't over leveraged and that used clear investing principles to get into deals and thus didn't have a lot of risk on the table. So just make sure that you understand your own clear rules. So as we wrap this up, how should you use the 1% rule in your investing journey? So use the 1% rule to stay disciplined. Let numbers lead, not emotions, and learn to walk away quickly. So great example of that is you're laying in bed, you're doing the calculator on your phone, you see a deal, it looks like it might meet the 1% rule, but you dig in a little deeper, you move on. There's always better deals out there. I promise you, there are always better deals out there. Every deal you've ever bought, there's probably a better deal out there. You just didn't find it. So as you gain experience, you may want to bend the rule a little bit intentionally. I personally don't like doing that. I like sticking with my criteria, and that is ironclad. Um, but you may understand trade-offs. As you get experience in, say, a particular market, you might be able to bend that rule a little bit because you understand that market. You've learned the market. You've done the due diligence. You dove into the statistics. So you can set a criteria, say 0.9% instead of 1%. But remember, you invest with purpose. You don't invest with hope. Let me repeat that. Invest with purpose. Don't invest with hope. If you haven't done your due diligence, you're guessing. So in closing, the 1% rule won't make you rich, but it might help you stay or it might help you not being broke. It's a filter, a guardrail, and a reality check. So if you want to invest long term and stay in the game, cash flow for clarity beats speculation every time. So I hope this helped. Um, Comment below if you have any questions or comments about what I said. Um, if you like this channel, remember to like, comment, and subscribe. It really helps me. And we're going to keep doing some of these deep dives over the course of this year. So I look forward to talking to you all. And remember, you can find me at my email is lance@lancehulseybroker.com. You can find me at lancehulseybroker.com or wealthbuildingbroker.com. I look forward to talking to you all. I read every comment, so please do leave comments. And I'm going to put that 1% spreadsheet in the link below. So go ahead and download that, and hopefully that'll help you kind of with your initial screening. Until next time, have a great day. I'll talk to you later.